Welcome, dear students, our class on accounting, accounting principles. Let us talk chapter 2. In this chapter 2, we're going to discuss a recording process. How the recording process going on. And the most important thing we're going to discuss in this chapter, that is debit and credit. The most hurdle that the students are facing. This is the study objectives. We will explain what is an account and how it helps in the recording process. We will define debit and credits and identify basic steps in recording process. So you know that the recording process starts with the account. An account, debit and credits are there, and we will explain the expansion of basic equation. Okay. Journal and ledger. We will discuss steps in the recording process illustration, and we will talk about trial balance later on. Okay. So account. What is an account? So see your slide. You will see that account means a record of increase or decrease in any specific assets, liabilities, equity, revenue, or expense item. So any item. So in the transactions, while assets, liabilities, revenues, or expenses. What about the changes? Changes come to your account. That's called account. So account divided into two parts in accounting, close accounting system, debit and credit. So most of the students ask, so what is debit and credit? The word debit and credit first used by Italian mathematician Luca Pacelio, 1494, used this term debit and credit. According to him, the debit meaning that in Italian language, word debere meaning owe, and credit free to entrust. So O means the business, the assets that you're bringing, and entrust means the investment that you are making for the company. Okay. So whole accounting that we divided into the account we divided into two parts, debit and credit. Debit we put in the left side. Sometimes it is said that from the debtor the debit comes, from the creditor the credit comes. Whatever, but this word widely used by Luca Pacelio, 1494. So for every transaction we have an account that's called debit account. For every transaction we have an account that's called credit account. Okay. So we show this debit and credit in a T account. It's in the picture you see, in the slide you see the account and debit and credit. Okay. So it's look like a T. So in the left side we put all the debit, and in the right side we put all the credits. Okay. So this two sides of accounting, sometimes it is also called double entry system, because for every transaction we put two entries, one for debit, one for credit. So each transaction must affect two or more accounts to keep the basic accounting equation in balance. So in the class you know that. So your basic accounting equation must be in balance. Okay. So recording done by debit at least one account must be crediting. You must do credit another account. So debit must equal credits. Okay. So in a later slide, you see that if debits are greater than the credits, the account will be called a debit balance. What is debit balance? Meaning that your debit is greater than the credit. So here in the example, you see that in the transaction 1, you did $10,000 debit. In the transaction 2, $3,000. In the transaction 3, $8,000. So you see that 18,000 minus 3,000. So your debit side is greater than the credit side. You see that you credit only 3,000. So your debit side is 18,000. So 18,000 minus 3,000, you have a balance. This balance 15,000. This balance is called debit balance. Why it is debit balance? Because your debit item, debit account is greater than the your credit account. Okay. So let's see another. What is credit balance? So it's just opposite of the debit balance. If your credit item is greater than the debit item, then we call it credit balance. So here you have three transactions. So out of three transactions, you have the balance 1,000. This 1,000 is greater than the debit balance. So very simple. Very simple. In a word, we can say if your credit amount, the money is greater than the debit amount. So this is called credit balance. Now, the most important thing that I'm going to discuss here, you see, debit and credit summary. So you see that some items would be normal balance, debit balance. Some items you see debit increasing assets. If assets increase, see here, assets increase debit, assets decrease credit. If you see here, expenses increase debit, expenses decrease credit. On the other side, you see liability decrease debit, liabilities increase credit. Owner's equity decrease debit, and owner's equity increase credit. See, for the students, it is very harder to remember these sorts of formula and because if you do not know debit and credit clearly, you cannot advance in the next step. This is most important formula concept for the accounting. Okay, so see here. So here we show the assets increase debit, liability decrease debit, equity decrease debit, revenue decrease debit, and expenses increase debit. So these are the debit side, and you see here credit side. On the other hand, assets decrease credit. So now I develop a formula. This formula works everywhere, and there are 1, 2, 3, 4, 5, 5 and 10. So 10 formula, you can use two formula instead of memorizing all those ups and downs, plus and minus, debit and credit. So the formula is very simple. I developed a formula. Just if you can remember these two terminologies, then you can overcome the hurdle that you're facing in debit and credit. So now I am writing one formula here: B E X. I say you see here my writing on the board on the slide. What did I write? ADX. So make it clear. So what is A stands for? If you A stands for assets, D stands for dividend or drawings, and EX means expenses. So if ADX increase, I'm putting it here like increase, up arrow. So ADX increase means debit. So ADX decrease means credit. Very simple. So within three, alphabet, you covered 6 formulas. So ADX. Again, I'm telling you ADX. A means assets. Assets increase, debit, remember. D means dividend or drawings, whatever. If dividend increase debit or drawing, if owner draws some money from the company, drawings increase debit. Expenses. expenses increase, debit. So what is credit? Just the opposite is credit. What is the opposite? Opposite meaning that if assets decrease, credit. Is dividend decrease, credit. Is expenses decrease, credit. So you do not need to remember uh, credit item. Just remember the debit item so that you can easily formulate. So if you remember the debit item, the opposite is the credit. Now how you can remember the credit, all the credit item again? So another formula I developed, C A L A R. What is color or color, whatever you say, color or color, okay? So what color stands for and how I can remember this one? Okay, I am putting a arrow mark here. If color increase, then it's gonna be credit, CR is CR, credit, okay? So now the question is, what is CA means capital. If capital increase, remember credit. If LA means liabilities. If liabilities increase, credit. What is R? R means revenue. If revenue increase, credit. So you do not need to remember the debit item because the opposite is the debit automatically. Meaning that if capital decrease, is gonna be debit. If liabilities decrease, debit. Revenue decrease, debit. So was just one thing remember. These two formula, if you can remember these two formula, your debit and credit is gonna be over. So all hurdles that you are facing on debit and credit covered by these two formula, and these two formulas are really very excellent and nice working because I developed it for myself for understanding the debit and credit because I was like you and I face a lot of problems. So again, some of the formulas, add x increase, debit. I'm writing here, add x increase, debit. Okay. What is add x? Assets, dividend or drawings, expenses. Add x increase, debit. And if the opposite, meaning add x decrease, credit. Just remember one, debit. Add x increase, debit, opposite is the credit. Okay. So color, again, capital, liability, revenue, increase, credit. So these are all credit. So this side is credit item. So this side is credit item. Capital, liabilities, revenue increase, credit, and the opposite is the debit. So your debit and credit problem, I think, over. Okay. So now let's move to the next slide. Now I need to erase all those items that I put here, add X and color. Before going to next slide, let me erase all those. Okay. Let me erase all those formulas. So these two formula is really helpful, and students, if you can understand these two formula, your debit and credit problem will be over, I think. Okay. Now let's go to the next slide. So what is debit and credit? Debit, increase assets and decrease liabilities. The quiz, I think, is easy. This is the homework. Maria Alvarez, a beginning accounting student, believes debit balance are favorable, credit balance are unfavorable. Is Maria correct? This is homework for you. Do it. So assets debit should exceed the credit, liabilities I already discussed. Creditors should exceed the credit should exceed the debit. The normal balance is on the increase side. So whatever the increase side is the normal balance. Okay. So here you see owners investment and revenues increase owners equity. So whatever the slides are coming, if you use the formula, then you can easily understand what is debit and credit. For example, owner's investment and revenues increase owner's equity. So owner's investment and revenues. Can you remember revenues color are increase? Revenue increase, credit. See here, revenue increase, credit.
Yes, sir.
And owner's drawings, debit. Can you remember ADX? ADX. In case of ADX, D. D means drawings. Drawings. See here, the picture. Debit, okay? So expenses increase, debit. Okay? Okay. The purpose of entering revenue is so it's discuss about the revenue. Expense have the opposite effect. Expense decrease the owner's equity. Okay. So this is another question for the class. Accounts that normally have debit balance are assets, owners' drawings, and expenses. ADX. Can you remember? So what is they have balance, normal balance, ADX, assets, dividend or drawings, and expenses, all debit. Okay, I have already discussed all these things. Okay, so so this is the expansion of the basic equation relationship among the assets, liabilities, and owners' equity of a business. So what is our basic equation? Assets equal to liabilities and owners equity. So in the assets, we have debit side and credit sides. In the liabilities, we have debit side and credit side. Owner's equity divided into some parts like owner's capital, owner's drawing, revenues, and expenses. All these under the umbrella of owner's equity. So owner's equity includes owner's capital, owner's drawing, revenue, and expenses. So if owners bring the capital, that's why it is plus. Drawings means minus, revenue is coming to the business, plus, and expenses meaning that you are taking out the money, that is going to be minus. So owner's capital again debit and credit. Okay. So the equation must be in balance after every transaction. For every debit, there must be a credit. So every debit, there must be a credit. Okay. So dear students, I think that's good enough for